Hey everyone, welcome to another video from Fundamentals of Finance. So today we're going to be discussing how to get from revenue to cash flow. Now this is important for three reasons. Now the first reason seems trivial, but it might be the reason you're here for. And well, it's because it's a pretty popular question when it comes to interviews in corporate finance and banking. Now, the second reason is that free cash flow is a very important metric and a very important number that we use in discounted cash flow or DCF analysis, which is a very, very popular intrinsic valuation method, which we will touch on soon in an upcoming video. Now, the third thing, and maybe the most important, is that free cash flow is probably the most important financial metric when evaluating the health of a company financially. And that's because it shows us how much free cash does a company have to reinvest, pay back in dividends, pay to debt holders, etc., after it has accounted for all cash expenses. So let's give a high-level overview of the process and how to go from revenue to free cash flow. So first, start with obviously revenue. So we start with revenue. And again, this is simply just the money that a company is making from selling its good or service, right? Then we subtract cost of goods sold. And cost of goods sold is all the costs associated with making said good or service. This could mean paying wages, or it could mean the cost of inputs, etc. This brings you to your gross profit or gross income. Then what you want to do is you want to subtract SG&A and other operating expenses. So SG&A is basically just selling, general, and administrative expenses and other operating expenses. So these could include paying wages of workers not making the actual good or service. This could include marketing expenses. This could include, for example, say general overhead expenses. This could include investment in R&D, research and development, etc. And sometimes you'll see D&A or depreciation and amortization listed as a separate line item on the income statement. But for our purposes, we'll just conclude that it probably falls under other operating expenses. So now this brings you down to EBIT, or slash, I should say, operating income. So now we're at EBIT, operating income. Now it's pretty simple to get to net income. We are simply going to account for financial expenses such as interest, for example. I'll try to show you guys is that right. Financial expenses. Now this will bring you down to your taxable income. Now that we are at our taxable income, let me lower this down so you guys can see a little better. Now that we are at our taxable income, now you just pay taxes, right? Pay taxes, and now you are at net income. So this is just a general high-level overview with a few examples of each line item of how you go from revenue to your net or take-home income. So now that we've given some context on that, let's go ahead and start explaining how to go from net income to cash flow. So let's start with net income, which is what we just got to. Now, just to give a little bit of context as to why I'm about to do what I'm about to do, keep in mind, free cash flow is the cash flow you are making as a business, or the net cash you are making as a business that is available to equity holders and debt holders. And keep in mind the keyword of cash. This accounts for cash expenses, i.e. operating expenses, SG&A, and even tax. an example, it should be physical money leaving your account. So the first thing that we need to do is add back DNA. We are going to add DNA, and there's other non-cash expenses as well, such as stock-based compensation is a pretty popular example, and there's other non-cash expenses as well. But these are just a few examples. Now, you might be thinking, well, we took out DNA to get to net income. Why are we adding it back? Well, like I mentioned earlier, when we are calculating free cash flow, we are looking specifically for expenses that actually make cash leave the account. And depreciation and amortization, though it does show us a loss in value of assets or intangible property, it's not actually money leaving your account. Same with stock-based compensation, which is why we make sure to add those two things back in when we're calculating the income. The next thing that we're going to do is subtract changes in net working capital. Now, what is net working capital? Well, net working capital is just current assets and current liabilities, to put it simply. And the reason why we're subtracting net working capital is because, for example, if we have an accounts receivable, meaning we've done our good or service, or we have a subscription-based product, whatever the case might be, but we haven't actually received the money, that represents cash that we have technically earned, but we don't actually have in the account yet. So that's why we have to account for changes in net working capital when we're looking at cash flow. So now this brings us down to what we call operating cash flow, OCF for short, also equal to OCF. Now, operating cash flow is basically the cash flow that is associated with a company's day-to-day operations. Now, again, it factors in things like cost of goods sold, operating expenses, etc. And looking at all of those things, you get to operating cash flow. This is the cash from just day-to-day operations. Now, we take operating cash flow, we subtract CapEx. Now, what is CapEx? CapEx is capital expenditures. This could mean, for example, buying long-term equipment. For example, if I'm a manufacturing company, I might buy some equipment for the plant or something to build machinery, build equipment, whatever the case might be. This is a long-term investment. The company is taking cash that it has earned through operations and is making a long-term investment in the company in the hopes that it will eventually use that equipment or long-term investment in the future to generate further cash. Now, the reason CapEx is not included in operating cash flow is because it's obviously a long-term investment, so it doesn't directly correlate to the day-to-day operations of a corporation. So you subtract CapEx, and that brings you to FCF, or free cash flow. Now, we've explained how you get to free cash flow. Now, let's just touch on a few more things before wrapping the video up. So, we've explained how to get to FCF, free cash flow. But there's a few important things that I'd like to speak about before I can say that we've put this topic to rest. So, free cash flow, just to clarify, is cash that the company has left over for both debt holders, right? Debt holders and equity holders. So this is the cash that people who own the stake in the company and people who have lent money to the company in the form of debt have access to. Now, typically, when asked in an interview or just asked in general about cash flow, typically the reference is unlevered cash flow. Unlevered cash flow just means cash flow with no leverage, meaning it is, again, available to both debt and equity holders. Free cash flow and unlevered cash flow are usually used synonymously. Now, let me just go ahead and erase this. Sometimes someone might ask you about levered cash flow, aka cash with leverage. So I would say levered cash flow. Levered cash flow. So what does levered cash flow mean? So levered cash flow is basically just free cash flow plus net debt issuance. And just to give a simple explanation, by net debt issuance, we're talking about either the company issuing new debt, such as issuing a corporate bond that would increase the amount of cash the company has, bringing in capital, or paying back debt, or paying back debt-related interest, etc. That is net debt issuance. So once we add that back, then you get to your LCF. Again, LCF is just levered cash flow. Try to make this not confusing. So levered cash flow, right? This just represents the cash that is available only to equity holders. So that's just a little bit of a slight distinction between the two, but typically when people are asking for cash flow, they are asking for unlevered cash flow. And another word for levered cash flow is also FCFE, or free cash flow to equity. Now the last thing I'd like to touch before I feel like we have sufficiently addressed this topic is sometimes you could be asked to get to cash flow, free cash flow, from a different starting point. We started from revenue, but if someone were to ask you how do you go from EBIT, for example, to free cash flow. So again, with EBIT, we have not accounted for taxes, but we have accounted for depreciation. So remember, the concept itself is not very different. There's just a few slight tweaks. So what you would want to do is, in this case, you would want to multiply by 1 minus the tax rate. Because remember, tax is a cash expense, and this is earnings before interest and tax. And then, once you have that value, you want to subtract D&A, because again, depreciation and amortization is usually included within SG&A or operating expenses. So it is factored into EBIT, and we obviously are subtracting it because it is a non-cash expense. And then the same thing as before, you subtract, I'll just use delta, net change in working capital, and you subtract CapEx, and this gets you to free cash flow. And you can apply similar process if you are asked to calculate free cash flow from EBITDA, for example. It would be a pretty similar approach. EBITDA obviously would just mean earnings before interest, tax, depreciation, and amortization. So the only difference is you would just take this step out, you would take this step out, but you would still obviously account for taxes and account for changes in net working capital and capital expenditures. So yeah, that is a general high-level overview of how you go from revenue to free cash flow, why free cash flow is important, and what exactly it means. I hope you guys found this helpful. Stay tuned for the next video.